want to thank Joe Czempoyesh for joining us today. I want to run a series of these videos with basically a pro panel. Joe is a mortgage specialist. He actually is a part owner of the Assured Mortgage Services Group. He runs one of the offices. And he's one of the smartest guys I know when it comes to lending as far as residential investment properties go and so on. So thanks, Joe.
Thanks, Vic. Thanks for having me.
Yeah. So we're going to break this down into a few smaller videos as we move forward, but we have a list of questions from some investor clients of ours, and I'll just throw one at you at a time and let you speak to those particular questions. The first one is a gentleman who says he has 3 rental properties and he owns his own home. The banks are not providing mortgages anymore for him. If he's trying to get another mortgage, he's running into issues. So what options does he have to buy a new property? I guess he has a pretty good salary. He has the 20% down payment. Where does he go from there? And when I first threw this question at you, I really liked the way that you approached it. You know, let's not wait till we get to that point. Let's go back to the beginning, and where do we start to set ourselves up properly?
Right. Okay, so we're going to circle around this because it's a very big question, and it is, we can kind of look at or approach it in the way that we can speak directly to this particular individual that already has 3, 4 properties. He may be speaking with 1 bank, 2 banks, not all the banks. There are some lenders that will allow you a couple more, but what's becoming more prevalent in the industry is that financial institutions are limiting the amount of doors or properties that people can own. I believe because they feel that they are becoming overexposed and they're trying to limit their exposure to risk. So for the particular person is at 3, 4 properties, 4 properties plus your principal residence is kind of the norm or the cutoff where lenders will stop lending you money on the next one. There are a couple of banks out there that will allow us a couple more depending on the individual's circumstances and situations, i.e. their ability to service their debt, their net worth, their credit, their income, so on and so forth. So that's one one part of the question answered. The second part of the question, or something that I would look at, is whenever we get into looking at people that have multiple properties or want to have multiple properties, is that we should always look at the beginning of the process. So where I find we run into a lot of trouble is that people have multiple properties, or they have 1 and want to go to 2, or 2 and want to go to 3, or 3 and want to go to 4. And they set the first one up kind of to make it harder for every subsequent purchase. So kind of, you know, and we're kind of taught like this from our youth, is that, you know, get your house and pay down that mortgage, right? Pay down that mortgage, pay it as fast as you can, build up your equity in your home, which, yes, in part is a very good way to do things, very good philosophy, but it also makes it more difficult for us to buy that next home. So whenever we're doing this, and again, to maybe circle back to the person that already has multiple properties, we don't know how they did that from the beginning going forward. So how do they look? So the idea when I was speaking to you the last time is that I said, you know, what we want to do is make the easy one the first one. Like set the first one up that you have as to make it easier for you going forward. Meaning, if you know that you are going to buy more than 1 property, more than 2, however many you have in your mind to do that, what you want to do is set the first one up so that it impacts your ability to borrow on the next one as little as possible. So, you know, if you can amortize over 30 years, amortize over 30 years. And this may be, you know, kind of counterintuitive and against, you know, how I may talk to somebody about being in better financial health, so to speak. But we can always make extra payments on the mortgage. We can always kind of, we can trick it, so to speak. We can set it up so that the mandatory minimum payments are there so that it doesn't impact our ability to borrow going forward, meaning that if I can make my payment $600 instead of $2,000, that's going to take up less of my income for me to use on the next property. So that was one of the things that we were talking about that I believe is fundamentally, significant in being a real estate investor, is make your mandatory payments as low as you can so that we impact your income the least amount possible going forward. So yeah, that's one of the things I think that we talked about first. So when we're speaking to people, whether they have no properties, they're first-time home buyers looking to get in, whether they have 2 properties, or like the individual asking the question, 3 or 4 properties, we would want to look at how that was either set up or how do we set that up. So we want to set that up so that we have minimum mandatory payments on each of our properties or the first property that we're getting into, because we want to make that easier for us going forward, right? Mm-hmm. And the other thing that I will add to that is going back to the person that has multiple properties that is looking to get more. What we would do, and as a broker, mortgage broker, we deal with, last year we dealt with 30 different lending institutions. There's a lot of different lenders out there. There's a lot of credit unions, a lot of trust companies, a lot of life companies, banks. There's a lot of lenders out there. Each of them have different policies, guidelines, different terms, different rates. So we exhaust the primary lenders first. And if I'm dealing with somebody right out of the gate, I'm going to set that mortgage up in the beginning so that it's easier going forward, meaning minimum payments. We're not going to go aggressive at paying down the principal right out of the gate. We can make extra payments as we go. Nobody's the wiser for that. No one knows when you make extra payments. It's not in your mandatory payments, so we don't have to use that for debt servicing going forward. But we exhaust the primary lenders first. So we go to whoever's going to lend us the money at the most reasonable terms and the best rates until we exhaust those lenders and they will not lend you any more money because you have too many properties. And then we go into the secondary market, of which there are many, many lenders out there that are willing to lend money on multiple properties at higher rates, and sometimes there's small fees involved in that. So it really depends on the individual purchaser. But I think that kind of answered the question there. Do you have anything that we would want to add?
Well, I think that just the way that they look at that situation, I think they sort of get bogged down on not wanting to pay those higher interest rates. You made a good comment there when we spoke last. They're looking around and they're hearing that people are paying 2%, 2.5% even on investment properties. And then they get somebody like you coming at them and saying, well, because this is your 4th or 5th or 6th property, I can get you a mortgage, but you're going to have to pay 6 or 7%. And they're thrown back with that. And I think the issue there is they're focusing on the wrong number. There's no problem in paying the 6 or 7% at that stage in your, with your portfolio, because you're probably still going to be, your return on investment on that 5th, 6th, or 7th property is probably still going to be, 20% or plus, right?
Yeah, very good point. And I like to think of it this way as well, because sometimes it sheds some light on that comment. You come to me and we start right from the beginning, you have no properties, right? Well, the first property I'm going to get you, or the first mortgage that we're going to get on the first property, it might be near 2%, right? The next one might be near 2%, and we have to remain current in the market, but right now they're near 2%. So the first, the second, the third, hey, Joe, we're doing pretty good here. We're 2%. And now I want to buy my 6th property. What? We're at 5%. We're at 4%. What gives? And why I say that is that we're not looking at the same institution or the same broker or the same financial advisor or we are looking at the same person that has increasingly gone up in rates, as opposed to a different provider altogether, right? So to comment on your question, hey, the last time I got these mortgage rates, I was dealing here and I was dealing there, but now what you're telling me is you can only get this rate, right? And it's like, well, no, I can get those other rates too if we'd have done that in the first and second property. And more often than not, I will get you more properties than you will get on your own with our mortgage providers, because we've set it up properly from the beginning, or we set it up properly from wherever we are on the timeline going forward, right? You know, we don't want to, and I don't want to call them mistakes because they're not mistakes, but we can make, let's call them mistakes for lack of a better term. We don't want to continuously make it harder and harder and harder for our subsequent purchases. Wherever we are on that timeline, we want to stop, take stock in where we are and say, okay, I've got to start setting these up so that my next purchase is easier. And then, yeah, to your point on that, with, you know, kind of zoning in on the, I don't want to pay these high rates. You know, you look at a property, it's got good value. The income coming in is going to cover the debt that you have to your satisfaction, because it's all dependent on your own financial, you know, your own financial situation. But this is a long-term play, right? And you got to look at this as like, this is the way I'm going to build my wealth, my retirement, my income. And is this a good business opportunity for me? And people tend not to think of it in those terms a lot of times. And I hate to paint everybody with the same brush, but you know, we kind of focus on interest rate versus how much income, how much equity am I going to build? How much interest am I going to pay over time? What does this look for me long term? And does it fit my financial plan? Right. So yeah, to your point, for sure. We look at these things. Well, now you're into the, you know, you're in your past 4 or 5 properties, and yeah, the lenders that we had that put the mortgages on the properties that you had before we got to this point were lower rates, and now we're into the secondary market and they're higher. But you know, overall, you're still making money. You know, and if you're not, well, then we have a consideration to make. But yeah, your comment is a very good comment, and a very good point is that we want to focus on the numbers. It doesn't make sense financially for us to do that and not focus on the interest rate that we're paying, because if we're making money, we're making money, right?
Yeah. We'll cut the first video here, and just watch out for the continuation of the series. Joe's got a lot of really cool stuff to say, so we'll have them up for you soon. Thank you.